Hello and welcome to Investing Confidential. Well, yesterday's action was predictable. Uh, as we told you, if you're following our videos, we told you the Fed was going to raise 50 and they were going to talk hawkish. It's exactly what happened. Despite what we think that Powell is a dove, he had to talk hawkish. He had no choice. And the market reaction was wrong again. Rally, and then fade into the close and closing on the lows, which is really bad. All right. Technically speaking, that's as bad as you can get. So again, you had predictable Fed, 50 basis points, predictable comments, hawkish, probably not going to raise 50 again, maybe in January, but then 25, 25. But and I quote Powell, for the foreseeable future, we will be raising rates through 2023. And he's sticking to his 2% target. Well, let me tell you something, folks. If he sticks to his 2% inflation target, okay, which he's not going to do, but let's say he's right now he's publicly saying that he's going to have to destroy the economy. Okay, again, he will destroy the economy, and maybe he will. He's made policy mistakes before. He's a moron. He will make it again. He's a court jester. Just again, don't fight the Fed. He's telling you he's going to raise rates till it goes 2%. That means he's going to crush the economy. That means the market's going significantly lower. Okay, forget pivot. This is why the market had rallied before. Everyone's focused on the pivot. Any chance they get to hear about a pivot or get wind of a pivot, they buy the market. As I said before, and I've been saying for 2 months, every rally should be sold. This is a bear market. Rallies need to be sold. Rallies are vicious, as we've seen in the last couple of days. Rallies are vicious, but they need to be sold. Focus on this. Don't focus on pivot. Focus on the fact that this Fed tightening is the quickest and most aggressive in the last 40 years. Okay, I've showed you charts about this before. You can't fight this. This hasn't even begun to affect the economy. We're just seeing the beginning of the signs. And you have to focus on this exact point. How is this going to affect the economy? This Fed tightening is brutal, and we're just beginning to see this. CEOs all over are telling you what's going to happen. They're looking for a recession. The morons on NBC and Wall Street, because these strategists are not never correct, are trying to paint a positive picture. I mean, this guy Kramer comes on and he's bullish, and that's exactly why you should be bearish. Okay, here's some simple things. Look at the shipping prices. Shipping rates are plummeting. Okay, this is demand coming from China. This is Walmart. Okay, this is Target. This is the economy. There's no demand for any products, and we're going into Christmas season, and we're still seeing this literally no demand. Okay, that tells you something. The economy's crushed. Okay, focus on the effect on the consumer. Again, these things are going to massively affect the consumer, and we're already seeing it. Again, these shipping prices reflect basically no interest from people from buying anything at this point. They're just not going to buy anything, and that's why you're seeing what we're seeing. So the consumer confidence is down. They're not buying anything. Christmas season will be a disaster. I tell you that right now. I don't care what the news tells you or again, as I told you before, all of these, most of this information coming out from the government is fake. It doesn't. It's the information is antiquated. Doesn't make any sense. Don't pay attention to it. The job numbers, the CPI, it's all bullcrap. It's all fake. Don't pay attention to it. I show you what really is going to happen, and I'm showing you the receipts and the actual data, and that's what you have to focus on. So, impact on earnings, consumer crushed, businesses crushed. How is this going to impact earnings? Obviously, an earnings recession is coming, as we can see. This is obvious. Okay, when earnings recession are coming, you do not buy stocks. Okay, you want to wait till the earnings bottom, then you buy stocks. When everyone's saying, "Oh, it's over," that's the time to buy. Right now, we haven't even seen the beginnings of this earning recession. It's coming. Okay, it's coming, folks. We've got to see it in the numbers. Now, Wall Street always has it wrong. Okay, look today. The strategists have targeted 4,000. We're at 4,000 today. They're looking at a flat S&P for the whole year. They're always wrong. It's going significantly lower. These guys are, whatever they do, you do the opposite. Actually, it's whatever they do, it's going to be significantly worse. So in this case, we're going to see they're looking at this is like a positive outlook, 4,000 to 4,000 target. No, it's going significantly lower. Why? Again, here I'm taking these from CNBC because I think they're no one watches it, but at least it's comical. They're saying there's a valuation problem. Obviously, there's a valuation problem. Earnings are going to come down much more than what these idiots are saying. PE is way too high. They're saying 19 times. We're significantly over 20 times. And so earnings are coming down. Forward earnings, real earnings, everything's coming down. Okay. And the price earnings ratio valuations are way too high. Let's look at the US versus the rest of the world. And if we do that, you can see right here versus the rest of the world, the US is the most overvalued market from a PE basis in the world. Okay. US is trading significantly over its average over decades versus Europe, versus Japan, versus emerging markets. US is way overvalued, okay? And that's the bottom line. And that's why you cannot buy US stocks, right? You can trade them, right? Because there's trading opportunities, but forget about investing in US companies at this point in time. If you want to invest in US companies, as I always said, find good companies, mainly small caps, mainly domestic orientated, and invest for the long term right now because the US is extremely overvalued. Well, look, I mean, I always talk about international. The US is overvalued, the US is a disaster, but the rest of the world's even worse. Look at Germany. This is the number one economy or the strength of Europe over the last 25 years, over the last 30 years. The German economy is destroyed. This is construction PMI, purchasing managers index. I mean, it just tells you what's happening. As we talked about PMIs, anything over 50, meaning it's growing, under 50 is declining. The actual number is not as much important, but it's the trend. As you can see here, construction, similar to China, is very important in Germany. Exports are number one, construction is number two. People invest. A lot of individuals and institutions put all of their money in construction and housing rather than even in the stock market. And you can see here the sentiment's terrible. Construction, housing, everything's plummeting in Germany. It's a disaster. And that's the strongest economy, so-called, in Europe. Okay, what's happening in China? Well, we've talked about China a million times. The economy is in terrible shape. Okay, and it goes back to this zero COVID. Zero COVID is crushing China. I don't care what the CCP is telling you. They can't stop it. And they're not even trying to stop it. They're saying, oh, we're lowering this and that. They had to do that because there's social unrest and they had to stop locking people down. But they're still forcing people to test. They're still forcing in smaller cities. They're still locking people down, believe it or not, even though they're saying they're not. They're liars. And the CCP can't stop it. Okay. And look, I think the long-term ramifications here, this is the most important thing that's happening in the world today. Look, the US is going to get over whatever it's going to get over. People are going to lose money in the stock market, crypto, whatever, but it'll eventually recover. We have presidential cycles, election cycles. And fortunately, because our system, the way it is, we throw the bums out, we get new people in, we throw them out, we get new people. But in places like China, you've got, it's authoritarian governments that control everything. Okay, the CCP is done. I'll tell you right now. You've heard it here first. The CCP in China is done. Okay, they're not going to get thrown out of power, but they are done controlling this country and manipulating the economy. Let me tell you a story. Going back when I was young, in the business in the mid to late 80s, everyone was talking about Japan. It was the Japan story. Japan's taking over the world. Japan's going to overcome the US. Japanese companies were coming in here, buying all the real estate. They were buying everything, right? All the iconic buildings around the country. They were buying companies. They were buying everything. Japan. Well, that didn't work out for Japan because the stock market in Japan peaked out in the late 80s and took 30 years to recover. Gone. Japan was gone, never took over the US. And everyone was telling, oh, you have to be like Japanese companies. Forget about Japanese companies. They're toast. They're gone. No one talks about them anymore. China's a similar thing. What have you heard for the last 15 years? China's manufacturing. China's government's great. We still got young people in this country who think socialism is great. China, communism, all of this. Well, it doesn't work, folks. It never works. These are authoritarian governments. Even Japan, to a certain extent, was authoritarian, but China's even more. And if you follow the history, okay, following history, again, Japan, China, very, very similar history. China, everyone says China's economy is going to take over the U.S. in a year, 2 years. Well, that's not happening. Even CNBC, which is really all their advertising is backed by China or some kind of China derivative. They're even saying now China is unlikely to take over the U.S. It's over. China's bubble is now burst. The CCP is done, and you can forget about China as an economic power in the near future, probably for the foreseeable future, similar to Japan. Took them 30 years to recover. So let's talk about something that's interesting. Talk about emerging markets, right? We want to talk about what the opportunity is in the next year, 2 years, 3 years. Where should we be looking to invest? And as you could see here, okay, emerging markets from a valuation basis is where you need to be. We are at a 2-decade low, okay, and all the signs point to a positive emerging market background. We are going to see eventually over the next 24 months a resurgence, continued resurgence in commodities, high inflationary environment, and most likely dollar weakness because the Fed eventually is going to throw their hands up and make another. They've already probably made a policy mistake. This is going to be a great time to be in emerging markets. Not today, okay? I wouldn't buy anything today, but you need to think about the future. And emerging markets, ex-China, by the way, okay? So right now the emerging market index is ETFs. So they told you want to buy ETFs. But if you look at the ETF, it's over 45% China. Forget about anything China and invest in Brazil, South Africa, Chile, other countries that are in a better, Malaysia, Singapore, other countries that are in much better shape than the developed world. And that's where the opportunities are going to be in the future. And we're going to obviously talk about that as we go on. But finally, I want to discuss about, again, we're in a bear market. What should we look for as a buy sign here, as a buy signal here in the US? Okay, I've shown this chart before. This is really interesting. Okay, if you look at, again, going back a number of years, bear markets, what do you look for? You look for a plunge in consumer confidence. We're seeing that today. We haven't reached the bottom, but we're seeing that today. The S&P, Dow Jones down 20. Well, the S&P is down 20, but Dow Jones is holding in there. It's going to plummet as well. I think you're going to see significantly lower prices, but that's something to watch for, right? Both the S&P, the Dow Jones, and the NASDAQ down over 20%. We're getting close to that. Monetary policy, again, positive shift in monetary policy, not going to be in 2022, possibly in 2024. So again, we're a ways, but again, these are things to think about. These are really things to think about of when we're going to see this market bottom here in the U.S. The problem with all of this data is essentially we are entering a policy shift in terms of rates going from going down for 35 plus years to going up. We don't know how long it's going to take. Probably 5 to 7 years. We will have high rates, okay, because inflation is sticky, as we talked about, and the economy is going into recession, meaning stagflation. So it's going to be a rough ride. These are things to follow. If you want this chart, reply to the comments. I'll send you this chart so you can have it. But again, if you're an investor, be careful out there.